Hey, ambitious dentist, welcome to Start Your Dental Practice, the show for existing and aspiring dentists to take your dental practice to the highest possible level. I'm your host, Jonathan Van Horn, CPA and ABV, founder of dentistmetrics.com. In every episode, we aim to demystify the how to start a dental practice problem by bringing on world-class dentists, influencers, and consultants in the dental industry to pick their brain about how to get past the barriers involved from going from no practice to being a practice owner to owning your own successful dental practice. Hey guys, so there are many reasons people get into dentistry, and one of them is the opportunity to be able to make money. But in order to be able to make a lot of money, there's a cost to pay, and let's face it, it's a high price to pay sometimes. So what's the best way to truly start building wealth? We're not talking about income, we're talking about real wealth. Well, I'm super excited to bring on today's guest. Reese Harper is the founder of dentistadvisors.com, a financial planning services company specifically for dentists. He's also the host of the Dentist Money podcast, which I highly recommend you check out if you want to gain a better understanding of money. And Reese will shed some light on the greatest misconceptions about wealth, along with some valuable tips to start building your financial portfolio. First, here are a few things you're going to want to hear about. Number one, why you should strongly consider hiring a financial planner, a key component to understanding wealth, which the majority tend to overlook this critical factor. The very first step in financial planning, what a total term is, and this is how wealth should really be measured as defined by Reese. Why financial planning shouldn't begin until this particular ratio has been figured out, which is going to help you get more of a sense of what's going on. Why it's important for your financial planner to know how to accurately value your dental practice. The financial areas you should focus on when you're getting out of school to prepare for you to buy the right practice. Who you don't want to get financial advice from. How to build up your board of advisors. And I think you're going to find today's bonus really valuable. And I really can't wait to tell you what it is. So be sure to listen all the way through this entire interview to get access to that. It's a really valuable one. Now, here's my interview with Reese Harper. Hello, ambitious dentist. Today I have with us Mr. Reese Harper. Mr. Harper is the owner, the creator, CEO of Dentist Advisors. Is that the actual name of the company, Dentist Advisors?
Yeah, dentistadvisors.com. We usually say that.
Okay,
that way It helps people know where to go to find stuff.
You know, the internet is a great place to be able to point people to nowadays. So, yeah. So Reese is the owner. It is a financial planning services company specifically for dentists. And so, Reese, thank you so much for coming on the podcast today.
Yeah, Jonathan, thanks a lot, man. I appreciate it. I've actually listened to an episode of your show too, and I think you've got some great insight for people. So I'm glad to be a guest.
So Reese, tell us a little bit about how you got into the dental industry.
I noticed I started in the financial planning industry in about 2003, and I had a lot of interactions with dentists throughout the early part of my career, and I just noticed how they were kind of in this unique camp. Everyone kind of knows that dentists tend to be a high income earning person. And so they're the target for a lot of salespeople. They're the target for a lot of people that may not have their best interest at heart, might be looking out for themselves. And they're also kind of ill prepared to analyze a lot of financial issues. They didn't have any, or in some cases, very little, business undergraduate experience, or in graduate school, sometimes there'll be one class on practice management or a few guest lectures, but understanding finance, like for me, like it's been a lifelong pursuit. And, I've got lots of credentials and undergraduate education and a lot of experience in finance, and I still find it to be challenging. And so I just felt like focusing my efforts on, I guess I'm kind of a softie. And so part of me like really wants to do something that's really meaningful for people throughout my life. I don't want to just work for money. I want to know that my clients actually valued that I was there and that we became friends and that they know I made an impact on their lives. And I think it's hard to do that if you're a general practitioner in financial planning. I think if you're a general practitioner, financial planner, you tend to just have your relationships are only about as deep as the investment accounts. themselves. It's about all you remember about people. They become more numbers because you're working with hundreds and hundreds and hundreds of people when you're just that kind of a financial planner. So I wanted to build a company that really limited the number of clients that we serviced to only dentists, and make sure that each financial advisor in my firm was able to dedicate a lot of time to each client. And so, our firm has anywhere from, 20 to 30% the client to advisor ratio relative to where other firms are. So you'll see an average financial advisor might have 250 to 300 different clients. Some will have 400. I've even seen advisors with up to 1,000 different accounts, clients that they interact with. And
Sure.
we really have tried to just stay really narrow, and it let us, by doing the business the way that we've done it, I feel like we just can make more meaningful change in people's lives and have more time to actually spend on each person. So that was kind of the whole reason to focus, I think.
So this may seem like a basic question, but I know I get this question a lot whenever I get new clients in, because they ask me questions about retirement. They ask me about investments and things like that. And I have to just quickly say, I don't know anything about investments. I'm not the investment guy. I'm not a financial planner. So can you explain to the people out there that right now that may, they know what the term financial planner means, but can you explain what it is that you do for dentists?
Yeah, like what's a financial planner actually do, right?
Mm-hmm.
We joke about that around here. It's like the most vague thing because it just seems like one of those things that everyone might want, but no one really needs,
Mm-hmm.
And so, and if you've ever met a few, you know that maybe they haven't added that much value. And so it feels like something that might be unnecessary to pay for. So I think the reason people should hire a financial planner is because it's really hard to keep track of whether your personal worth or your personal wealth is actually trending in the right direction on a regular basis. And that's kind of the big picture. We talk about what are you worth? Like, what is wealth? What does wealth mean? And a lot of people interpret that differently. Some people feel like wealth is a lot of stuff. It's that they have a lot of locations in their practice, or they've got a nice car, they've got a nice house, and for us, that's part of it. You got to know you got to know what all your stuff is worth, but you also have to know how much you actually consume each year. What do you live on? What do you spend? What's comfortable? Not in a way that makes you feel like you've got to deliver pizzas at night, like Dave Ramsey might say, or something, but it's something that lets you just be real about it. Like if you spend 11 grand or $11,400 a month, just own it and know that that's what you're spending, and try to measure that. And so the way we look at wealth is we just take what someone's worth and we divide it by what they spend in a year. So if let's say your practice is worth $500,000, or let's say you're an associate, that might be more applicable. Let's say you're an associate and you're just out of school and you got a $500,000 student loan, and you got no practice ownership, you got 10 grand in the bank. That's the common scenario for a lot of people, right? And
the Miller High life.
Yeah, dude. I mean, in that scenario, you're worth about negative 540,000 or negative 490 or whatever. You're not worth anything. That's okay. I mean, you just basically got a business loan to get things started out of the gate. And I had to do that when I started my company. I had to go get an SBA loan and I had to go into debt, and it wasn't worth that much for quite a while. And so I think the first step in good financial planning is knowing what you're worth at any given point in time, tracking that, and then making sure that you're real about whether you're making progress. I might add just one thing into this, which is, let's say you know what you're worth today, Jonathan. Let's say that a dentist knows that he's got $250,000 of cash in his practice, and personal checking and everything, and he's got nice little baseline now, and his practice is worth another 250. So he might be worth 500,000 now, right? As a person, he doesn't have any debt on his practice. It's just a startup, and he's got maybe 150,000 of debt, and it's worth 400 or something. Say we calculate his total worth, and after we add up all his stuff and subtract his debts, he's worth 500,000. If he spends 100,000 a year, we would call that a 5. 500,000 divided by 100 is a 5. We call it a total term. Mm-hmm. So if someone has a total term of 5, that means they could kind of last for about 5 years. But if another dentist with the same $500,000 of net worth only spent 50,000 a year, he would be worth a 10, right? He could live 10 years off of his $500,000. The guy that spends 100,000 can only live for 5 years. And we look at those two people and say one is wealthier than the other one. Even though they have the same personal worth, one consumes it at twice the rate of the next person. And so we really try to emphasize that is kind of the point of a financial planner, is to track what you're worth and track what you spend and give you advice on how to make that ratio, your total term ratio, improve over your lifetime. It brings the focus really onto the right areas, spending and tracking the growth and performance of all of your assets. So a little boring, but that's kind of the general premise of like, what does a financial planner do? If he's not doing those two things, like meticulously tracking all of your assets and debts and helping you measure exactly how much you're spending, then he's really not providing a baseline of value, in my opinion. It shouldn't just be you buying an investment account from somebody, or you buying an annuity or a life insurance policy or disability insurance. That's not financial planning. That's implementation of financial planning, but that shouldn't be like the core of your relationship with a quote unquote advisor.
I love it. I just earlier today had a discussion with Dr. Tom Larkin, who is a fantastic entrepreneurial dentist. And he was quoting some research that just came out that said that the equivalent wages from Memphis, Tennessee, if you're doing making $125,000 as an associate in Memphis, Tennessee, in order to be equivalent in that, you'd have to make $300,000 in New York to be able to have the same amount of income, just the income, because of the cost of living differences. But he says if you were to, if you were to double that in Memphis to be 250,000 versus 600,000 in New York, the cost of living, your churn rate would be so much higher in New York City. You'd have a lot more wealth by being that person in Memphis, because your cost of living doesn't change when your wealth goes up, or, hopefully.
Yeah. That's good insight.
Yeah,
I think it's important to think about that. And a lot of people complain about the insurance reimbursement rates in their market, right? Which in some areas, in the country, insurance reimbursements are really poor. Mm-hmm. And guys kind of get beat up out of shape over that because they feel like they're not making any money, or they wish they were in Seattle, or they wish they were in New York, or they wish they're in California. But the reality is, like you said, sometimes in places where the incomes might be lower on an absolute basis, right? That may not necessarily mean that their lifestyle is worse, right? And
sure.
And we see that in a lot of cases where a dentist making $350,000 in Southern California is not the same as a guy making $350,000 in Memphis, or in Georgia, or in Florida, or in Maryland even. So it depends. Like, I love looking at wealth on a relative basis, and we don't do financial planning on an absolute basis. Like, I don't care what you're worth, I don't care what you make, until we convert those numbers into ratios that are comparable. Then we don't even start financial planning. And we really feel like good financial planning, it doesn't begin until you've converted all the numbers into ratios. And that's where you can actually start making sense of what's going on. So,
and you mentioned earlier about adding value to the financial planning aspect for dentists. How is it that you guys go about adding value to your clients that a general financial planner just couldn't do?
Well, I think that it's a great question. And I think any specialist, like a CPA, like you, Jonathan, I could put that question back to you and go, well, how do you add value? And it's pretty easy to start like saying, what are the things that kind of come up in the course of a conversation that you feel like you can respond to as a CPA that's specialized in working with dentists, right? Or as a financial planner that's specialized in working with dentists. If a dentist comes to me and my experience, like, as a financial planner is interacting with not just the dentist, but I interact with marketing firms, consultants, attorneys, CPAs, bookkeepers, all of the office managers, different associations. I ask financial questions of all of these different people, right? And you start to gain a lot of experience in areas that are slightly outside of maybe your service deliverable of what you're going to do, but you have opinions, a lot of opinions. And if me and Jonathan, if you and I are working together on a dentist that we share, and the dentist has a marketing question, and he brings it to us, it's likely that me and you have seen this marketing strategy implemented in multiple dental practices, not just this one time. And we can both kind of say, Jonathan, what do you think? I don't know. Let me ask Reese. And then we can ask a consultant that maybe the client's retained over the years, and that consultant has an opinion and their attorney might have an opinion. I guess my point is, if you can build a board of directors, kind of like an advisory board of people who really specialize in dentistry, they're going to be able to give you a lot of second opinions on things that you would have never been able to get from a general practitioner. I think that's the biggest value, is just being able to get advice that is kind of unexpected. Like, I have opinions on practice overhead and how to compensate hygiene and front desk, but that's not part of my service. It's just, I've developed opinions about it. I also have opinions about digital marketing and print mailers and events and consulting arrangements and insurance reimbursements and technology to use and all that stuff you gain opinions about. And it's just free advice. It's like, you just have a lot of free advice to give because you've been in their sphere for so long that you've built opinions. You've seen who's good at what they do. Hopefully that makes sense.
Oh yeah, it absolutely does. And I'm sure there's a lot of value also there from, when you think about retirement, most people, when they use the term retirement, now I know you're a financial planner and we weren't, retirement is definitely a part of that.
Yeah.
But when you think about retirement, you think about whenever you sell the practice, right? I remember when I was managing the firm I was at before I started this company, that the CPA that had been ahead of this retiring doc, who'd been a CPA for, I don't know, 800 years, he thought that the value of the dental practice was something like $2 million when this practice had only had like revenue of like $500,000 for the past 15 years.
Yeah, totally. I just skipped over the obvious like financial planning value adds. I'll hit on that in a second.
Sure. No, that absolutely, it ties in there to being able to know that if you know what the value, these are just intrinsic things that you learn after being so ingrained in this industry for a while.
You're bringing out like a perfect example, man. I mean, that example of like, why does your financial planner need to know how to value a dental practice? Well, let's say I'm sitting down with you and you're 45 years old. And you're 45 years old and you've got some money to invest every month. And you've got a chunk of money, but you've now finally like got a lot of your debts paid off. And it's time to really start like putting money away seriously for retirement. Your normal financial planner will sit down with you and he'll say, when are you going to retire? And you'll pick an age and they'll say, how much do you think you can save? And you tell him your number that you think you can save, and he'll kind of run a retirement plan and go, okay, I think then because of these numbers you give me, we should invest your money this way, right? It's a mix of safe investments and ones that will grow more, that he feels like by the time you're, let's say 65, it's going to be a nice blend the right way. Mm-hmm. If I sit down with the dentist when he's 45, I'm not going to start asking him how much he can save. I'm going to say, I need to look at your tax returns. And then I need to look at your loan amortization schedules. Let me look at your practice collections numbers. Let me take a look at those and I'll tell you how much you can save based on the numbers that I know are normal ranges for people at your level of income and collections. And then I'll look at your dental practice and say, because the dental practice is worth this much, when I'll first run a projection. I'll be like, I think this guy at this pace has a chance of retiring somewhere between age 57 and 59 based on all the data that I'm looking at, because that's when he'll hit a total term metric of 30, which is very specific to knowing some stats about dentists. And then I can say, because I think he'll be ready at about that point, but I'm going to be selling a dental practice at that age. At 57, that's when I'm planning on receiving a lump sum of cash at this valuation amount. It affects my investment plan in a huge way because I'm not going to begin withdrawing on my investments until after I've spent the money from selling the practice. And when Social Security kicks in, that'll even extend the life that I can withdraw on those practice sale assets. If I sell my practice, kicks in during that time, maybe that practice sale actually lasts me 7 or 8 years. And my investment portfolio now at age 45 can be invested a lot more aggressively than I might have otherwise been able to invest it. Because as a normal financial planner, I was disregarding the sale of the practice as a part of my retirement plan. I didn't know how I was going to use that money during my retirement withdrawal strategy. And consequently, I see all the time where guys will have really, really conservative investment portfolios like late in their career. And for the last 15 years, they'll have been making 3-4% returns on their money because they're so scared about, getting to retirement and having, 2007, stock market, kind of 2008, 2009 Bear Stearns, like that soured a lot of people on investing in equities. And then 2001 and 99 did. It's kind of been a bad 10-year period for investing. So most people are naturally super conservative. They pile up a ton of cash and they don't really grow their assets because they're so worried. And then they get this windfall of cash at their retirement date that they really didn't know how to quantify before. And the investment plan the whole time was just kind of screwed up. No liabilities. We call it liability asset matching, like you would know as a CPA. And they're not clearly matching their expenses up with the asset that they're investing. So you really need to take each investment that you do and say, when will I withdraw the money? How long do I have exactly? And that lets you have much more aggressive investment plan than you would otherwise. By aggressive, I mean one that's going to just yield higher returns, even though it might move up and down a lot along the way. So anyway, long story, man.
No, yeah, that's perfect. So let me ask you this. I've had some people that came to me with this question as well. And again, this is related to financial planning. Maybe they've been contracted with a CPA or someone that is also a financial advisor, and they charge a fee-based service in addition that they are required to use if they use them as a CPA. Mm-hmm. I've heard $600 up to $1,200 a month just for this, advisory service. And the people that I've heard it from were actually startup practices. So like they were literally making negative money every month and still having to pay out this financial advisory service fee. Is that something that, it makes sense to you or?
No, I think what you want to do is, good financial planning firms realize that you don't want to ramrod the wrong service down somebody's throat. You have to have, a good entrepreneur builds service offerings that match up with where people are really at in their life. And they don't try to force something onto somebody else. And someone getting out of school, getting started, they need liquidity. They need to build up cash. They need to get a good foundation of assets under their belt so that they can buy the right practice, relocate, become a partner if they want to, or just get an emergency fund or a down payment on a house, or get life started. That's generally like those are the important things to do early on. And so what you want to do is you want to get adequate counsel. Like I think during your whole life as a dentist, you need advice in every area. Never think that you don't need advice. Just realize that the cost of good advice goes up over time as you need more of it. And when you're young, you need an hour, 2 hours a year of good financial advice from a good financial planner. You just don't need a monthly service that's very robust. If you were just getting out of school and you bought a $2 million ortho practice and you were instantly earning, a lot of money, that may affect your decisions. At that point, now it's less, you have no time. You can't even mow your own lawn anymore. You're done, right? It's just relative. I would say financial planning complexity scales up as you get wealthier. Your time goes down and you get more wealth. And I would say out of school, I mean, I want to see we call it a 6 LT or 0.5 LT. We want to see people have at least 6 months of personal living expenses accessible to them before they buy a practice, before they buy a home. We want that to be left over even after they buy a home. Like we want people to do that before they start consolidating student loans and accelerating the debt reduction. I mean, stick with them income-based repayment for a while, build some liquidity, get into the right location. That's kind of the general advice I would give people. But yes, get a financial planner. Just engage them in a way that's not super expensive. You can do it for an hour or two a year, up to 3 or 4 hours a year, maybe, if you're trying to deal with like some complex things. But don't get your financial advice from people that are selling you stuff. It's not financial advice if your life insurance agent who's getting paid a commission to sell you life insurance gives you financial advice. I mean, that's not financial advice. That's ancillary advice from someone selling you something. And so get a consultant and pay them find someone who's willing to give you 1 hour of their time, but don't pay someone who wants 50 grand. Find a financial planner who's willing to give you 2 hours, but don't, hire someone that's wanting to take $1,000 a month out of school or even less. I mean, you just don't need that level of service. I think that everybody just needs to be willing to pay for a lot of different types of advice at the level that fits where their wealth is at the time. And maybe hopefully that's in line with the way other people think, but I doubt it is.
That was a very diplomatic answer. And my answer to those people is, I'm not a financial advisor, but I think the best financial advice that person could give you is to fire them.
Yeah, dude, that's great. Right.
So just because at the time, if they're making negative money and they're not investing any money, they're paying for nothing effectively.
Yeah, I mean, I think there's a difference between paying for a service and then I think a lot of times people associate that fee with like investing money. That's not financial planning and investing money are two totally separate things. They're just not the same thing. And you just don't need a lot of financial planning early in your career cycle. You don't need a significant amount. You need some.
So that leads me to my next question. When is like the perfect time for people to start, whenever they're picking out the board of directors, for them to pick the financial planner on their board of directors?
Yeah. I'm biased, but I'm biased because I think that too many people don't hire a financial planner until way too late. And the financial planner can provide some really interesting insight that you won't be able to take advantage of if you wait longer. They can provide a lot of insight about debt reduction, refinancing, debt repayment. And a lot of people don't actually have quite as much insight as a personal financial advisor does, at least as it relates to debt reduction. And that's because we see loans refinanced that's a big part of what we do as a specialist firm. We do millions and millions and millions of dollars of refinance proposals that we know tons of different banks and tons of different brokers. And, we know how to analyze fees and who makes sense and who doesn't. And so I think you want to retain a financial advisor and a CPA as early as possible in your career. I would get one within the first year. Just engage them though. Like literally you should be able to say, look, I just want to set up like an IRA, a Roth IRA, and put an emergency fund together. And I want to have some 1 to 2 hours of advice throughout the year where I can just call you and ask you if you think what I'm about to do is stupid. That's all you want that first year, first couple of years. Just make sure you at least have that guy, and you need him from day one. I have a lot of clients that aren't even out of school yet, and they've become a client that's just we call it our Model 1 client. It's just a basic level of service where it's as needed hourly support at a really reasonable rate, and then we help them set up basic investment portfolios to kind of get them started. So they got an IRA, a Roth, they need to do their first simple IRA, they need to set up a SEP because they're a subcontractor. I mean, just basic stuff for the first year or two, but you don't want to wait to get that person involved. I just think it's a cost you got to be willing to bear at a low level for the first year or two. And the same thing with a CPA, don't do TurboTax and don't do H&R Block. just get someone who you can start building a relationship with, because the most important thing isn't whether they're going to actually help you that year. The most important thing is getting someone who starts to get to know you, getting someone who gets to understand who you are, and has a vested interest in supporting you and defending you throughout your career. That's important. So anyway.
Don't downplay the simplicity of setting up a simple IRA. I just had to deal with a client who had his financial person set up an IRA for them. He wanted them to set up a simple IRA. He communicated a simple IRA, but the advisor set up a traditional IRA for him and his practice and all of his employees. And
my gosh, dude.
And the guy had significant assets in a traditional IRA already, so he couldn't do any type of Roth conversion or anything like that. So instead of getting like the 12.5 and the match on his contributions, he got like no tax benefit from his IRA contribution. So it cost that doc, $3 or $4 grand in taxes probably. So
that's important. I think you get a financial planner right out of the gate. You just make sure that they're a specialist, make sure that they know what they're doing, and make sure your CPA or we always say the first board member, whoever is your first board member. In our case, sometimes we're the first person a client hires and then they hire a CPA. In some cases, they've got a CPA and then we're a second or third board member. Whoever is already on your board, we'll just call it an informal advisory board or a formal advisory board, however you've structured it. I think you should have any new hire or any new person you bring on as a board member, make your other board members vet that person. And if more than one person doesn't like that person, something's wrong with that person. Okay. So, if it's just one guy, if your CPA doesn't like your financial planner or your financial planner doesn't like your CPA, there's something wrong. You just don't know which person's really probably not able to play nice. If there's three and two people say the one guy's a nut, then you can kind of start to gauge. It takes some time to build your advisory board, but I'm really a big believer that if people can't get along, something's wrong with them, and just get rid of them. That there isn't like a perfect person out there, and there's never a perfect advisor, a perfect CPA, but they all need to be working together. And if they're not communicating, then all you have is a bunch of isolated subcontractors, and you're the manager. These guys, your team needs to be managing your stuff, not you. And they need to have enough discipline and personality needs to be friendly and warm enough to where they can get along with people and not live in an isolated island,
Completely agree. So let me ask you this. What, you've been very gracious with your time today. What's a good way for someone to be able to get in contact with you if they have any questions or anything like that?
I would just say go listen to our podcast. The Dentist Money podcast on iTunes is probably the best way to start learning about how we think. And on our website, dentistadvisors.com, you can get guidebooks and listen to industry expert interviews and listen to the podcast. You can get ebooks, and there's a ton of information there. If you want to just ask me a question directly, just email me at reese@dentistadvisors.com. and REESE at dentistadvisors.com. Our phone numbers and everything are on the website, and videos are there, a lot of training materials. So anyway, man, I think that's probably the best resource.
Fantastic. Well, you've been a wealth of knowledge, and we really appreciate you coming on, and I hope the best.
Thanks, Jonathan. Appreciate it, man.
A special thanks to Reese for sharing his valuable time with the ambitious dentist community. As you heard, there's a lot of misleading information out there about how you should be handling your money. Reese opened our eyes to some of the things to look out for. And as a bonus for today, you can take advantage of a free 1-hour consultation with Reese. That's right, 1 hour of Reese's time and insight for free. And now Reese isn't even the person that typically talks to people anymore because he's busy running the business. So this is a key introduction to the owner of this company, to someone who has a ton of experience in this world. So I highly recommend you take him up on this offer. So to get access to that, simply text the word practice to 33444. Again, that's practice to 33444, or visit startyourdentalpractice.com/bonus if you're outside of the U.S. You also receive updates on the latest episodes of Start Your Dental Practice, helpful tips for owning and running a practice, and promotional opportunities direct to your inbox. So that's it for today's episode, but that doesn't mean that the learning and implementation have to stop there. I've created a free report called the 15 numbers that will make or break your dental practice. This report has been downloaded over 1,000 times by dental professionals. So if you want your free copy of this report that's going to outline what the most important numbers are in any dental practice, and it also includes how to look at your numbers, how to set goals, has a whole slew of really important information that is the culmination of all of my experience as a dental CPA, then just go to startyourdentalpractice.com/free gift. That is startyourdentalpractice.com/free gift. And so that's it for today, Ambitious Dentist. Again, I'm Jonathan Van Horn, CPA and ABV. I'll see you next week with another world-class practice owner or consultant that will help you start your very own dental practice. Thank you guys so much for being a part of the Start Your Dental Practice community. If you enjoyed today's episode, please do me a favor and go to startyourdentalpractice.com/iTunes to leave your honest feedback and review on iTunes. It's going to help me create a better experience, a better show, a better podcast for you, the ambitious dentist. Your feedback really does help, regardless if you like the show today or not. If you didn't like the show, let me know, because it's going to help me create a better show and podcast for you. Lastly, if you know of anybody that would benefit from today's episode and today's content, today's guest, please feel free to share with them on social media or through email.